name's Enrique Allen. I helped design the Benrock Quarry, which is like an early stage incubator for like more seasoned entrepreneurs. Last year with Fund Rev, which is more of an accelerator, grant-based model, and then now with 500 Startups with Dave McClure, which is a mix of kind of seed stage funding and also a subset of our portfolio companies that participate in our accelerator, incubator, whatever you want to call it. But happy to talk. Thank you.
I'm David S. Rose. I'm a serial entrepreneur turned serial angel investor. As an angel, I'm one of the more active ones around. I've got about 80 companies in my portfolio. And as an entrepreneur, I founded something called AngelSoft, which is the very quiet, some of you may know it, some of you may not know it, but it's the underpinning of the entire global early stage ecosystem, which we can talk about. That's what this panel is about.
Hi everybody, I'm Danae Ringelman. I'm one of the founders of Indiegogo, or the leading global online funding platform for projects and ideas. So anyone with a creative cause or entrepreneurial endeavor can use our tools to raise money online through their network and extended network. It's not profit participation. I might be the only representative from that. Oh, you do? Okay, I take that back. But we sit in between donations and investing. So people offer perks, they pre-sell their work. They offer special access as a way to raise the money for their project.
Hi, I'm Jenny Casson. I have a cold, so I sound terrible, and I also can't hear very well, but I will do my best. So I represent a few different organizations. I work at Katovich Law Group, where I'm an attorney, and I also manage a law firm, and we do all kinds of legal work for startups. And then we also recently started a new company called Cutting Edge Capital to focus on more creative ways to raise capital.
Yeah.
Capital, so we're becoming experts on more creative ways to raise capital from a broader range of possible funders. And then I also work with a nonprofit called Sustainable Economies Law Center, which is trying to get the word out about some of the legal issues that surround social enterprise. And one thing we did is we submitted a request for a rule change to the SEC to allow $100 investments without registration.
I'm Jouko Ahvenainen, and I'm co-founder of Crow VC. And actually, Alan told something about Crow VC this morning, but I would say that we are maybe the leading global crowdfunding service. And what we are doing is really equity investments into companies, so that it is not only for ideas, or it is not a donation, but it is equity investments. And we have a global service where we have investors and companies around the world, and we have now started also the first local services, for example, in India and China.
Yeah. So some of the things I've been noticing in the last 5 or 10 years, some of the trends. I mean, we're sitting in the building that Tandem really started in. To start a company in the 80s, you needed a lot of capital, because they bought a lot of computers that were very expensive and built buildings and data centers. Now kids can go and slide a card into Amazon or Rackspace and start a company, and we've seen many examples of companies that have started with $10,000 of capital, $40,000, $100,000. It's rare that you need them, even more than $1 million now to start a company. It's rare. It's an exception when you see somebody getting the $10 million or $20 million investment today to start a company.
There's actually some data. Every year in the United States, 7 million ventures get started. The average amount of capital that a venture needs.
The microphone is back up by that. Yeah.
So every year in America, I read this article in Entrepreneur Magazine a couple months ago, and she said, and the writer Kate said, quoted some data. Every year, 7 million new ventures get started in the United States. The average amount of capital needed by those 7 million ventures is $45,000. The median amount of money needed to fund those ventures, so 3.5 million ventures, need actually less than $4,500 to get started. That's the world we live in.
One of my other hats is, how many here have heard of Singularity University? Anybody? Okay. I run the Finance, Entrepreneurship, and Economics track at Singularity U. Sorry. And with the exponential technological advancement, as you were talking about, my first internet company required $20 million in VC to get to internet product ship. My second internet company required $2 million in VC to get the internet product shipped. Then after the crash wiped everything out, and my wife said no more starting companies again, and I was relegated to being an investor, the first company I invested in as an angel, along with Nicholas Negroponte and the Andrew Weinrich, who founded social networking, that only took $200,000 to get the internet product shipped. And then a couple of years ago, New York Angels, the group I run in New York, invested in a company called Pond5, which is an online marketplace for royalty-free video stock footage. When we put our $500,000 check into them, they were up operating with a full management team and generating revenue. Total dollars expended to that point, $20,000. $20 million, $2 million, $200,000, $20,000. The costs are dropping exponentially.
But where I was going, go ahead.
I just want to clarify, like, from my bias, coming from like the Stanford Design School and the whole lean startup methodology, I think it's important to caveat that these are like temporary organizations. I mean, are they really long-standing companies that are going to last the test of time? And there's a different investment models that all of us are banking on at the end of the day. But from my perspective, I think access to this seed capital is just all about prototyping your way to discovering these kind of scalable business models. So I don't really, I mean, I think we've reduced a lot of friction for brilliant people to get incorporated, to have legal services, admin, all those other things, so they can just focus, I think a lot of what we're missing right now, there's a lot of froth, there's a lot of like pseudo-innovation, a lot of incremental development across kind of this perimeter of technological apps and options. So I think what we're really missing right now is that capital to really empathize and truly uncover latent needs, which I think are the most disruptive, but I'm not going to get into much more of a soapbox about that. I just want to caveat that these are temporary kind of prototypes.
Where I was going with this trend thing, so as the costs of companies are coming down, I've been to Techstars demo days, AngelPad, and Y Combinator demo days. I'm seeing the number of angel or small investors, micro VC investors, or the Dave McClure style investors is going up, which is pushing the valuations up. I just talked to Paul Graham at Y Combinator. He said valuations today at his level are 3 times what they were 2 years ago, which was slightly depressed because of the valuations. But I want to see what you guys think about those two trends. And are we in an angel bubble?
We are in a frothy atmosphere right now. In certain quarters caused by certain types of a small subset. But the bigger trends here are actually much, much bigger than the Y Combinator graduates getting a 5 million valuation instead of $1.5 million. I mean, that is true, that is happening. We've had some interesting spirited panels and discussings as to why that's happening. But I'm not sure that really is taken. Just to put things in perspective, at the same time that those numbers came out, we did a sort of informal survey among the leaders of all the angel groups, the major angel groups in the country. And it turned out that the median pre-money valuation was $1.5 million. And so that's not, and so what's happening is people who know what they're doing, really doing the numbers on it, valuations are actually, if not going down, they're at least certainly holding. It's in the frothy part of the valley, crunchy world here that things are getting a little strange.
Yeah. Anybody else on that?
Yeah, I think that what is important
hold the mic a little bit further.
What is also important to see is the global aspect, so that it might be that the valuations are very high in some places, but I think that there are a lot of still differences between different places, and actually
I don't know, I was in Tel Aviv in April and I met 3 venture capitalists on one street corner.
Yeah, maybe Tel Aviv is not the best place to talk about. But I think that for example, what we want to do is to make more transparent market in that way, that at least you can see around the world that what kind of companies and innovations they are available, and then it's easier also to select that what makes sense and basically to get the whole market work better. Because I think that if we think the early phase funding, one problem is that it has been based so much on these local or personal networks, and it is not effective market if we think the definition of effective market, that all parties have enough information, there are enough deal flow and competition and that kind of things. And I think that this would be really important to get the market more effective, so that basically startups could have more options to select what kind of investors they would like to have. And on the other hand also, that the investors could really see much more deal flow, compare companies, and then make decisions based on much more information.
We really are seeing a regionalized angel network, right? Boulder, New York, Seattle, San Francisco, LA, Omaha a little bit.
We were there.
I was there, but it's a little bit. But after that, it gets hard. It gets harder and harder to name another city. I mean, London, there's certainly London, Shanghai, Beijing, some places in India are just starting to cook. What are we seeing as a worldwide, to bring in the worldwide aspect to it? What are we seeing, and really, is the capital going to remain centralized in a very few cities, right?
Actually, what's happening is the U.S. is leading the way, but the rest of the world is absolutely coming up. So AngelSoft happens to be the official software for the World Business Angel Association, which is the umbrella international NGO of all of the regional and national groups like the Angel Capital Association in the U.S. and the Australian Association of Investors and so on. So AngelSoft right now is operating in 60 countries, 60 countries. And to put things in perspective, we've got over 30,000 accredited investors in the platform. So there's no question, and some of the most interesting and active deals responding to really rational metrics. Mumbai Angels India, they are doing spectacular stuff. I actually belong to Mumbai Angels, and I just flew in this morning from a Peruvian company in which I invested. So you're seeing, we're not aware of it here because they don't get the TechCrunch coverage, but it is without question happening globally.
Yeah, just more from Indiegogo's perspective, we've actually spoken in 5 countries about Indiegogo's platform and the tools for Do It With Others fundraising. But our tool is in 139 countries. And that just shows that people are starting businesses around the world. So the supply is global. That's no different. And we're talking about market forces, supply and demand. If the angels are the, or I guess if you want to call the entrepreneurs the demand and the angels or investors the supply, it'll even itself out. So it's just going to grow. The more global we can be. So all these people who are raising money, they found Indiegogo because internet is global. Like there's no regional differences. So it's just going to take time, but it'll get there. And we already have.
So why is the capital still centralized into 10 cities then, if it's a global world? Right? Well, why isn't there capital in Montana and Kansas and in
as more companies and as more startups and more ideas bubble up because they can raise money through their networks or whatever, not necessarily go for the angel investment money first, but prototype themselves, get themselves out there, get them launched and a business model going, then the investors, I think, will come find them.
Just one quick stat. The Angel Capital Association has members, I believe, in 48 states. And there are very active regional networks in Wisconsin, in Ohio, in all kinds of different places.
The U.S. securities laws make it almost impossible for 98% of people in this country to invest in a business, a startup, or even an existing private company. So I think that's a big reason why you really see a lot of concentration, and that's a huge problem that we're working on and trying. There are some ways around it, but it's very challenging, and most people have no idea how to tackle that.
I think that one issue has been also that basically, as we heard also in this morning, that not so many people, even they have money, they have experience to make startup investments. And as somebody said in the morning, that there are many people in Florida or people in Latin America that they basically could have money to make investments, but it is something what they don't know yet. And they know, for example, how to invest in real estate. And that is actually something what we have also wanted, that with very small investments, like micro investments, that one value of that kind of investments is also to educate new people to understand that there is a kind of asset class to invest also in startups. So, and I don't mean that they must put all their money to startups, but 5% or 3%. And I think that would be important, because anyway there are still many investors who only want to make investments in their own country or even their own city. And I think that is another aspect, that it takes time that people learn that actually you can invest in Mumbai, or you can invest in Singapore or New York, even if you live here. But these are that kind of things that I don't think that they happen overnight. That it takes time, and first there are some people who do it, and then there are more people who follow them.
Do you see that there's more willingness to invest in companies that are just going after a smaller region? You know, Silicon Valley, it gets the TechCrunch headlines because we care about world brands. We care about the Tumblrs or the WordPresses or the, you know, or the the companies that are trying to, Facebooks and Twitters and stuff that are trying to build a world brand. But there's lots of, I mean, entrepreneurs who built very successful and very profitable businesses that just go after Brazil, for instance, that don't get the headlines because they don't care that they want to be globalized.
The challenge here is that we are in a period of flux, clearly in everything, and we are heading to a globalized world. So I would posit that in some period of time, 2 years, 5 years, 20 years, pick your own time frame, you have to be a global brand. You have to be a company. You're in 169 countries, we're in 60. Whatever you're doing, if you're a one-person blogger, your entire consumer base is global, and everything is going to be virtualized and global. This is my singularity hat talking over here. And the second issue here has to do with the economics of funding startups. It's very risky. In case anybody here is wondering, you'll lose your money. You know, sort of guaranteed. And so the portfolio makers for VC funds and angels are like the 1 in 10 that's the home run. And it turns out it's just as risky to start a small business as to start a large business. So if you're going to put your money into something, you might as well try for somebody who's into the stars. So those are the two factors that are playing into this.
But isn't risk coming down slightly because now it's going to be more based on execution? Funding is based on execution, not based on a great idea and a great business plan like the guy was talking about. So execution can happen anywhere.
But adoption is getting harder. It's getting easier and harder, right? It's easier to get to 1 million users, but it's also
they're worth less.
They're worth less. And for me as a user, I'm getting more and more adverse to trying new things. My iPhone has 350 iPhone apps on it, right? And only of the early adopter audiences I speak to, only 4% of the people have more than 100 apps. That tells me that there's a resistance to trying new things. So if we're going to fund more and more and more startups, they're going to hit harder and harder times or more and more risk, as you say, right?
But one point is that how much they get money and how they could get money step by step. And I think that at least we have very much that vision that company could, for example, start with very small funding. And then they could make step by step so that you basically see that what happens. And actually we see that the crowdfunding is one way also to test how many people are interested. But anyway, to get the market work in more effective way also in that way that basically you don't have to think that I now try to get as much money as possible because it is so difficult to make this VC funding round. But you could take that amount of money that makes sense, and then you can demonstrate what you are able to do, and then maybe you get more money.
Do we need VCs anymore? And a good example of that is right around the corner from my house is a company called GoPro. I don't know who has heard of the GoPro camera, but if you saw the miners coming out of the Brazil mine, that camera that was shooting those miners was a GoPro camera made here in Half Moon Bay. That company was started with a bead business out of a VW bus. No venture funding, no private funding. SmugMug, just down the street here, is a photo sharing site that's very popular and very profitable because they charge their users. And they went and did not raise money and have built a very nice business without VC, without angel. Do we need angels and VCs in this new world? Good question. Yes.
Probably for growth. Still, I think that's what you were saying earlier.
But like SmugMug's hosted on Amazon cloud servers. If you're profitable, can't you fund the growth by building the company internally? You don't need money to buy a data center anymore. Amazon has the data center. You just pay for the.
Right, but
if 100,000 customers show up, you pay, and you're getting paid because they're in a paid model.
I think you can do a lot more with a lot less, which is I think what we're all agreeing to. But I think ultimately, if you want to go global and it's brand building, it's called marketing, and marketing costs money. And yes, you can do still a lot for free with social media and make it organic and authentic. which will get you much further than you could before, but still you have to pay for PR.
And that's to your last
And
point.
that as an example of something that,
Yeah.
not
And
like.
and that's to your last point about decent local businesses. What I think the overall picture here over time is that you're looking at a global world of niches. And so it's possible to have a small business that's not trying to build McDonald's or whatever it is, but instead of being focused in Cupertino, it could be focused on everybody. My avocation is letterpress printing. So, so I handset type, and my little coterie is a letterpress mailing list of, 1,500 letterpress printers from 16 countries. So you're going to have, I think, out of a 5 to 10 billion global population, you can hit smaller things, but it won't be geographically constrained.
That's good stuff.
So number one, and number two, relative to the second question about, do you disintermediation of in a capitalist society, or a capitalist global economic system, there is a need for capital to be invested to create things. Not necessarily to start things, as we're seeing. You can prototype. I disagree with you that the only businesses that are being funded now are prototypes. But it's much easier to get started now. But still, you're going to require a lot of later stage capital to expand and to scale, right?
Yeah, there's even a company here in Campbell that lets you test your website on a napkin. And so you draw a wet napkin and you send it to your Twitter account, and they come and see if it's an interesting idea. Gauge the Eric Ries idea, right? Eric Ries has this thing called Lean Startup. He said, I spent 6 months once building something and nobody downloaded it. And he said, that taught me a valuable lesson. Test it if people are going to
test. But I think that what's going to happen is that ultimately you're going to see capital coming in at the appropriate stage. So most VCs, traditional VCs, are moving upstream. That's why you've seen the quote super angels, aren't super angels, they're micro VCs, but they're coming in to fill a market niche which historically wasn't served of people trying to raise $1 million instead of 3 to 5. Apex and I mean the first VC who funded me were with Pincus. Well, could a $2 billion fund. They're not coming in and funding $100,000 investments in startups out of Y Combinator, right? So I think you will find increasingly people bootstrapping. In case anybody here is an entrepreneur, the best way to do it, don't take funding from any of us. Okay, go and bootstrap your own company. That for several reasons, that's by far the best. But then there will be things that companies that, AngelSoft, which I've done for 6 years now, right? And our goal is to be a platform that everybody ultimately here can use. We should talk about partnerships, but that was something that didn't make sense to pay its way early on. So that required investment. There will be other things like that.
Yeah, we'll just quick backtrack. I mean, I believe we're on the forefront of trying to be as international as possible. Dave's on a plane all the time. We do Geeks on a Plane across Southeast Asia, East Asia, be in South America this March, April, if you want to come. So we're certainly trying to leverage platforms, grow VC as well. So I think that is important, that just the physical presence, just getting on a plane, that's just so crucial. And likewise, we are seeing different deal valuations from companies who are coming outside of Silicon Valley, and that causes both opportunities and a bit of a legal mess too sometimes. So that is some friction that we're dealing with right now. But in terms of the type of investor, I think that's really important. You're seeing a specialization. We're seeing all these different types of accelerators, super angels, micro VCs that are specializing in different things. In our case, we're making a bet and focusing heavily on design resources. We think that there's a big design gap in early stage startups, and that's just one kind of value proposition that we can offer. Just like YC attracts a lot of hackers, like they attract a lot of designers, and provide resources accordingly that are scalable and not just dependent on one individual like Dave McClure. And so I think that's really critical to, as you mentioned, in stages, that we can start to have some type of accountability as you're testing these different design hypotheses, these different hypotheses about your business. And I think that's what's critical to mitigating risk along the way versus just giving someone a big kind of check and then kind of seeing what happens.
So I interview a lot of startups that have 2 or 3 people, built an iPhone app, got to 200, 300,000 users, so they have some adoption, they have a team, and they're shopping around for funding. What should they expect to see in the funding environment right now? What kinds of terms should they be expecting to get? How much of their company should they expect to give over for the funding? what's happening for that small 2 to 3 person company?
I will tell you that at a panel last week, Dave was saying, oh, I'm sort of price insensitive because I'm going for the home run, so I'm the one who, so he took personal responsibility for the increase in frothiness of valuation.
Not saying I agree with everything that we're doing. But anyways, one example I think, so again, I'm not excited about throwing around somebody else's money or masquerading as an angel, but I think there are ways, like, how many people are entrepreneurs in the room? I know who I'm talking to. And how many are investors? Okay, so I can be a little bit more pro-entrepreneur. So yeah, FBCs. Why? If you can make cash validate your business model, and then eventually when you need to hire some kick-ass engineers that are 100 to 200K a year, then maybe you need to take some growth money. But besides that, I think there's other options. So we've done a number of micro funds, a Twilio fund as well as a crowdflower fund, which are more like contests that are on a rolling basis, where you can just if you're a developer interested in building on a particular platform, you can develop apps, in this case a mobile app as you mentioned, and really clean terms, standardized, transparent, it's open. And
what should you expect? How much funding should you expect to get? Let's say, is it $1 million? Is it $500,000?
Well, for the Twilio fund in particular, it's like $10,000 for 1%, and for a $50,000.
So that's very early stage, almost
very,
like going into a Y Combinator.
Exactly, and then so we want to be positioned both, pre a little bit overlap with YC, and what we currently most of our portfolio is a bit after YC, and we've actually invested in a number of YC companies. So again, to that gap, but I agree you should try. The more that we have transparency, and I hope to learn more about the legal aspect, the more we have transparency about these terms on a global level, I think the more empowered entrepreneurs will be able to make better decisions, and we'll be able to reduce risk.
I would say, once you get past, your question had to do with an iPhone app in the Valley, which is a different kind of world, right? So once you get past that little teeny weeny piece of the entrepreneurial ecosystem, what we're seeing in general is for a startup business which has some traction and some team and really has a something, but is pre-revenue or certainly pre-profitability. The range globally is sort of 500,000 to 2 million pre-money valuation, and you're raising something in the order, it smells like 100,000 to 1 million. You want me to put rough numbers on it? Mm-hmm. That's roughly where the world is. So that's not the 4 million pre-money that's coming out of Y Combinator, and it's not the the $100 you need for a Twitter app. I mean, but generally speaking, if you've got something that looks like it could be a viable business, you're talking north of 5 and under 2 is the range. But I think the more interesting question that I'd love to sort of shift a little bit to is all of these various platforms and tools and people who are trying to, we're all in the same space, which is enabling entrepreneurship globally and funding entrepreneurship globally. One of the things that AngelSoft will be doing, AngelSoft, for those who don't know, is the back-end platform that currently, as far as people know, is the tool set for the organized angel world, right? Over 500 angels in 60 countries. What we will be announcing later in the next quarter or so is the grand plan, which has been underlying all along, which is to provide a tool set platform for everybody who is in this space. And so if you have an ecosystem or you have an idea to enable entrepreneurs, for-profit or not-for-profit, in this space, if it involves dealing with entrepreneurs who are creating economically based businesses, not for nonprofits. So stuff like you're doing.
Not just not-for-profit.
No, but primarily, if you have a project which is not designed to be the next, purely economically based, thing, then that's the area we're focusing in. Commercial companies that are looking for equity investments, not loans, not pre-selling of things. From what is effectively now angel investors and startup entrepreneurs. As that broadens out into $1 million, $2 million, $5 million, $100 million, whatever it is, people, and as the costs and as we enable people at lower and lower dollars to play in the system, not being accredited investors necessarily or qualified investors in the U.S. So what we have done is to create a platform that now has 6 figures of people on it who are players in this space and known entities. And so whether you call it single sign-on or tool sets that will enable anybody in this space to tap in to this truly global world, we would love to talk to you because that's what we'll be doing.
Right.
Yeah, actually there were some questions earlier. First of all, I have one comment. Do we need VCs anymore? I think that there are a lot of differences also between industries. So that, for example, in biotech or something like that, you need much more money. But one fact is that VCs must also think that how they are going to operate in the future. because one problem is that they haven't made money so much. And LPs are not happy, so that the question is that if they don't get money, it's difficult to have VCs after that. So that when they always expect that companies must be innovative, I think that VCs should be also innovative, how to develop the model. But then another thing that I think that the ballpark, for example, what we see at the moment, how much early phase companies are looking for funding, I think that it's typically in our system something like from 50,000 to 300,000. There are somebody who is looking for 10,000, somebody who is looking for 1 million. But I think that the reality is that there are so different kind of companies that, for example, if somebody has only one iPhone application, I don't know if it is really a company in that case, because as somebody said that if you make if we compare this to music business, that if you make one song, one hit, it is not enough to start a record label. And I think that it is very much the same with these applications.
All the Twitter did it, Foursquare did it, right? Yeah.
Yeah. But another thing.
They're not the rule. They're the exception, probably.
How much money they raised.
Yeah.
Yeah, and one more thing actually, what we have, for example, in our service, that people can also work for equity for companies, and I think that that is also more and more popular, and we have been actually ourselves very successful to use this, so that there are many people who are actually willing to work also in this way, and actually I think that it's a good way to also find people who have a real passion, who really believe in the company.
I'm actually really surprised that there haven't been more roll-ups of iPhone apps or mobile apps companies, because you're right, there's all these companies that have pretty sizable audiences, but they're one-hit wonders, and you're probably right that most of them won't turn into a major business. But if I was a VC or somebody who had a lot of money, I would be looking at a roll-up strategy of, hey, let's buy 20 of these companies.
Right?
Yeah. The iFund is certainly Kleiner Perkins, but they have a lot of money.
How are you going to buy up 20 companies, Robert? I mean, how are you going to contact?
I don't have the money.
It's not the amount of money that matters.
Yeah.
I mean, how do you physically do 20 transactions? I mean, think about it. I mean, so it's not just about the size and scale and the amount of money you've got. There's a lot more complexities that prevent that from going on.
Are there synergies between those companies?
Yeah.
I mean, how do you cross-sell?
Yeah, you're
What
looking
you're
for
saying is-
efficiencies,
is-
you gotta figure out a strategy, I mean, maybe you have some sort of idea. Tell me which 20 to go, because I got the money.
Okay.
But that's the problem, ex post facto picking. What you see a bunch of people doing are starting companies to enable deployment of iPhone apps. And so that way they start before you know which ones are the ones you want to invest in. So they have a portfolio out of the box of 100 or 1,000.
And you're talking about Chomp or AppsFire, those companies where you can go and find a bunch of. Interesting.
Well, maybe that's.
Actually, we're talking about whether you require a VC. We're still talking about 10% of the industry.
Yeah.
We still live in a physical world. We'll need smart grids, new roads, new water supply. We will stabilize in 30 years at 9 billion people in the world. But after we are done with tweeters, I think Twitter will be used to generate the next better roads and better, it's all capital intensive.
Yeah.
And VC has not moved there. Renewables, has no investment like that.
Yeah.
And that requires $100 million investment. And I think
You
that's
sound a lot
where-
like Vinod Khosla. He's funding concrete companies that are CO2 friendly. So, any other questions? Because I think we've started getting a conversation going here.
Just on the VC, clearly a lot of smart people, but why is their success rate so horrendous?
Starting a business is tough and risky, and most of them fail.
Building a plane's tough and risky, but is that?
I think because this is all exit oriented.
Because what?
Exit oriented, short exit.
Yeah,
They're trying
the
that.
window is too tight.
So tight.
Yeah.
You gotta have a window of 30 years and then be more successful.
Maybe 10 years, but
Yeah.
at least some sustainable.
Okay, you want to put your money into which companies are going to bet 30-year exit over there, and you better be right.
Okay, thanks.
I'm quite interested in this idea of regulation, legal regulation. Is this really going to kind of, we're in a moment in time, I think we all agree in this room, that is transformational. flux is used. Certainly agree with what Michael was saying this afternoon. How important is it, do you think, that governmental level regulatory bodies will start to understand actually that they've really got to sort of disentangle some of this kind of stuff? We know that actually in the US it's really, really tough, whereas actually in other parts of the world, legal regulation enables these types of things to happen in completely different ways, and that could really kind of be, a pivotal point in terms of where innovation comes from and how it's funded. I have my own personal view on this, but I mean, I'm very interested to hear what you
That's a hot spot for me. I mean, clearly, I agree with you, and clearly, it is so clear to me that I have no question that it's going to happen. So so my world is that it will happen. The question is when. It's not going to happen. The political situation in the U.S. is such that it's not going to happen tomorrow, as it was the current banking bill almost knocked out angel investing altogether by elevating the accredited investor status to $5 million. And so the interesting thing about that was this one line in the Dodd-Banking bill said, oh, we're going to increase the accredited investor status to $5 million, which where all of a sudden every angel investor, wait a minute, that'll knock out 80% of the angel investors in the U.S. And, hello, in Congress, do you know what you're doing? To which their response was, what's an angel investor? So finally, after, we didn't mean that, right? So finally, after that got changed back, the sort of angel industry now is saying, well, yeah, maybe it wasn't such a bad thing that they tried to kill us because they didn't realize they were killing us. Now they at least know the term. But eventually it will change, I think slowly, but I think you're looking within 5 years. That's my guess.
Only 5 to 10, I think it's 5 to 10% of total capital invested in new businesses every year comes from venture capital and angels. I mean, we're kind of talking about such a niche here, and it's kind of the elephant in the room. Like 80 to 90% of capital comes from people, their savings accounts, they're refinancing their mortgages, credit card debt, because most companies are not these VC-backable stuff. That's the engine of our entire economy here. And I know we're focused here on technology.
That was going to be my question, is what about the market that matters, which is not the one that's going to return a VC's fund, but the one that's going to return 10 stable jobs, 100 stable jobs, 1,000 stable jobs that may not ever require VC funding.
Right, and when people can invest in their cousin's friend's restaurant and put $1,000 in for profit, and he can put it up online, and they can do it in a legal way, that's not legal right now.
So
I think Jenny should jump here, because she's
you
an expert
focused
here.
on projects, and I know what your returns look like. What do you expect in terms of percentage of deals that look like they'll go VC versus the rest of the market, which is most of the market? How?
Are you taking me?
But well, you're operating in this space where you've already said that you've got a bunch of people who take a little bit of money and they go see. Your site clearly states go for public capital, right, as opposed to private, and I can only assume at $100 you're talking about non-VC funded businesses. So I'm curious what your expectations are around how big is that market, how many businesses are out there, who's not funded because of those limitations?
Well, if you just think about the average person in this country, what choices do we have about where we can put our nest egg? Incredibly few. I mean, I would much rather take some of my nest egg and put it in the restaurant owned by the cousin of my friend that I know is a really good restaurant, I know it's going well, but I cannot do that. Occasionally there are ways that it can be done, like Indiegogo is one way that it can happen at times, but generally speaking, it just cannot be done. And we're talking about trillions and trillions of dollars that has to go into these mutual funds of publicly traded companies. We have no choice to put it into something else that we might feel better about. So if we could loosen up some of that money, I mean, it's a huge market failure, because if you look at the number of companies that cannot take money from 98% of the population, it's a huge number. I mean, it's probably about half of the economy. So about 2% of the population can invest in what's half of the economy. That's a huge market failure, and I think I have so many clients that they would have no trouble raising money from friends, fans, customers, but it's illegal for them to do it. So I'm not worried at all about the availability of capital. I'm just worried about the regulations that prevent it from flowing where it should be going.
Yeah, maybe I can comment also. And another part of this is that when people make these investments today, for example, friends and families and so on, I would also ask that maybe sometimes they are not so effective investments, so that if there could be, for example, let's say better visibility for this market, they could even make better decisions that where they invest their money. And then an other aspect is that as we have seen that it seems to be at least easier in some other places than in the US. There are complexities around the world, I can say, and we have spent quite a lot of time to thinking about these models. But for our plans is now to start also something local in the US, and definitely US market is quite complex from this perspective. Actually, I must make one comment when people talk about here that how many countries. Actually, we have people in our platform from 179 countries, so it's a big number also. I didn't know that there are so many countries.
Yeah. Cool.
And just on that, I think is another example of us kind of getting out of the bubble of the startup community, where I think actually a lot of the innovation that we're going to see around finance is actually coming from the social sector, from the sectors where they're creating things like social impact bonds, where governments are saying, well, I need this performance, this metric to happen within welfare reform or something. So they're saying, we'll put up this amount of money if those things happen, and enabling an entire community of capital to form around it. Organizations that are actually coming up to find, how do I find new ways to bring in our retirement savings eligible investments into my ventures. So that's where a lot of the pressure is coming, and it's hitting at the governments where it counts in their social services. So I think that's the avenue where we're going to see a lot of this innovation bubbling up in the social finance that will create opportunity for entirely new models or ways that for capital to flow into the market. That's again, I think it's another example of how everything's converging in really interesting ways outside of our conventional styles of looking at it. Good point.
One thing I just want to say real quick is to remember though, whether you're a VC, an angel, the number one thing people are investing in are people. Management's the most important thing. It doesn't matter what size of an investment you are.
Yeah.
And so getting back to Jenny's point, if I had the opportunity to put my money into a stock fund that I don't know the PM for, and I've seen the returns, but I have no idea what it's investing in, or I can put my money into someone that I know who works really hard and has built a couple businesses or whatever, it's a no-brainer because I know that person and I trust that person. And that can't happen right now. So with a little bit of regulation to relax the rules to allow people to invest in people that they know, then the average person, the common person, can put $1,000 to work. And in aggregate, when you've got millions of those people doing it together, that's changing the way things are getting financed. I mean, with Indiegogo, we do it for not equity investing, but we let people invest in people that they know by contributing and getting something out of the experience. The only thing they just don't get is the profit participation.
It's not only the regulations that about investors that are SEC regulated. It's also from an investment advisor perspective. So the brouhaha that you have to go through to become a registered investment advisor is enormous. So if you want to help people by helping them analyze who are qualified investors, it's really prohibitive. It's a huge barrier to entry.
And I never did answer your question about returns, and I do want to address that. And I have an example. There's a company called Equal Exchange, which sells fair trade coffee and chocolate. And they have a really interesting model. You can never sell your investment in that company for anything other than your initial investment. It can never grow. However, they do shoot to give you about 5% annual dividends. It's not guaranteed, but they have met that goal more or less almost every year for the past 20 years. And they have a chart comparing how you did if you invested 20 years ago in equal exchange versus how you did if you invested in the S&P 500, and guess which one won? So check out Equal Exchange as a really amazing example of a company that is incredibly socially responsible, is creating wonderful jobs, is creating wonderful business opportunities by setting up co-ops all over the world to to grow coffee and chocolate, and provides a really reasonable return. Not the type of a return that a VC is looking for, but a really good return that most of us would be happy to get.
I think what these comments point out is that right now we have a very stratified system where you have venture capital, you have private equity, and you have venture capital, and you have super angels, whatever they are, and then you've got angel groups, and you've got angels, and you've got Indiegogo, and you've got your friends and family, and you've got your circle, and so and there are a lot of things that are going on. Indiegogo is a great example. Kickstarter, ProFounder, Circle Lending, Virgin Money, Prosper.com, all kinds of ways that are trying to free up some of this extraordinary amount of capital that is available there. On the other hand, to be a wet blanket for a minute, this stuff is very risky, and the average person with a substantially sub-accredited investment number shouldn't be putting 25% of their income into a restaurant of their cousin.
I think the public companies are kind of risky too.
But I think what's going to happen here.
Investing in Apple is.
Banks are really safe, I think.
But if you're only investing $100 versus a quarter of your net worth,
Right.
it's different.
And how much did we all lose in the past 10 years?
I'm not saying that the stock market is great. I'm just saying that this stuff is really risky, and I can tell you that as an investor. That being said, I think the leitmotif here among everybody that you're hearing the panel and all the other people who are in a similar world that we are is you're going to see a much greater, much smoother spectrum. And it's going to go from tools that will enable you to do a pure friends and family around with no equity, with no put your own cash in intelligently, get friends and family, go to a wider circle, affinity groups, go to individual angels, go to super angels, go to VCs. And whereas right now they're highly stratified, we are moving to a world within a few years where whatever number you need to play at, wherever is appropriate for given your income, given the relationship, is going to be able to do.
So. Back there, I'll come back.
Yeah, kind of extension of this continuum idea that I see going forward is that actually venture capitalists who plug into like crowdfunding and incubator platforms. So these platforms are great signals for venture guys, ways of screening out. You've got a bunch of people saying this is interesting to me, sort of customers are speaking or whatever. So I actually think rather than think about you can certainly, go from a crowdfunding platform to a VC. I like to think about the continuum where they're all playing together. The herd is running together, all kinds of different sized animals. Like I know Grow VC actually has already announced something like that, right?
Yeah, that's right. Yeah, that's right. But one comment is that there are some venture capital companies that understand the value of that, and they have, for example, there are some who want to work with us and make co-investment and utilize all this information that is coming. But I must tell also another example. I was talking with one venture capital company in London, and I thought about this, that doesn't it tell something that if 5,000 people is ready to make investment in the startup company, and this venture capitalist answered to me, no, because you must be venture capital professional before you are able to evaluate startup companies, that average people are stupid.
Did that VC ever run a business?
Actually, they are one big name.
Yeah. Well, they may be a big name, but
yeah, I don't know exact numbers.
Was he an operating entrepreneur?
That's a very European attitude too. I hear that from the entrepreneurs in Europe, that they keep hitting cultural attitudes that are very anti-entrepreneur, and that's why a lot of them move here, because they love being around other people who love entrepreneurs and egg them on, where culturally around the world, that's still a difficult thing.
Yeah, and maybe also that what is actually come to this, that how successful are venture capital investments, because, for example, I checked the background of this person then, and actually she had actually she was graduated in the US, but actually her background was very much in investment banking, analyst, and then venture capital, so that basically no background to really work for a startup company.
Any last thing? Because I think we're pretty close to the end of our time. We're going to continue this with the incubator panel. This is sort of like part one of the new funding, and I on purpose kept away from discussing a lot of the incubators that are starting to spring up. Dave McClure's 500 Startups is a good example of that. And we'll talk about that in the next panel after this next one, right?
That's right.
Yeah. Cool, thanks. Thanks for joining.